Hey guys, this is going to be a trade review from my most recent trading week, which was June 6th through June 10th, 2016. Those of you who have watched these videos before, you know the drill. I look at every single trade I made, go back, check out the charts, and just critique myself, mention what I did well, what I did poorly, and just kind of talk about how I can get better. So, first trade of the week that I made. And just to clarify something, so every time I make an entry, it shows up as a trade in my accounting, the way my platform does it. However, many times it's just one trade. So like numbers 1 and number 2 here, they were the exact same trade on Tesla puts. So I'm just going to treat that as one trade. So you might see that it says I made a total of 24 trades this week, but in reality, a couple of them were the same entry just at different times on the same trade, so really I only made 18 trades. Alright, so first trade of the week, I shorted Tesla by buying puts, the 210 strike puts at 9:47, 17 minutes into the day on Monday rather. So what I was looking at on Tesla, I came into the week saying that 215 was a key level. This pink line represents 215. And so what I saw is I saw a move down in the stock below 220 in the pre-market and then moved lower right away. And so I put on a short kind of versus the 217 to 218 range was what I was looking at as my stop, where I said, hey, if this thing stays below 217-ish, 218, then I'm going to be looking for a 215 breakdown. So I got short on this, bounced back up right here after this move down, and then I end up taking a loss on the position at 9:59. So at 9:59, that was this move right here. And so the reason I stopped out was it started to move through 217s, which I didn't want to see, and it was making a new 15-minute high. And 215 was a key level, so I felt like it had defended 215 and was, starting to bounce, which it did end up doing as the day progressed. So, something that I like, something that I don't like. Number one, what I don't like about this is my entry is kind of in no man's land. Somewhat of a no man's land entry. And I know I was trading versus 217-ish, but 217 doesn't really represent a level of major significance to me on Tesla. When I think about what my notes were coming into the week, I needed to be trading against 220 if I wanted to go short, or I needed to get short on a 215 breakdown. I try and anticipate the 215 breakdown, but obviously it didn't work. So somewhat of a no man's land entry is a problem. Also, I never buy premium on Monday. I've just learned that buying premium on Monday for me isn't something that I'm very good at. And of course, in this trade, I do just that. Furthermore, I buy 2 contracts, which again, on a Monday, which is a day I don't trade premium well to begin with, that just doesn't make a whole lot of sense to me. So don't like that. Now, what I like the best is how I handled the stop loss. Once it looked like I was wrong, I just got out. And as you can see, the stock did rally the rest of the day. So it was a good thing that I took my loss. So good job taking the loss, regardless of if I shouldn't have been in that situation in the first place. Shouldn't have been in that position in the first place. The bottom line is I was, and I managed the loss properly, in my opinion. So bad entry, good recognition that it wasn't going to be a good trade, and got out. So next trade, so I try to do something different then. So again, number 3 and number 4, this represents a spread trade. So I still liked the idea as of 10 o'clock of shorting Tesla, but I wanted to short call premium instead of owning puts. So I looked at shorting the 222.50 by 225 call spread in Tesla, and I shorted it for 56 cents, which is a little bit more than 25% of the spread, which is what I try to get when I short call spreads, is at least 25% of the total spread. But a couple problems with this. So I entered at 10:09, and if we look at that time, Tesla had been basing and starting to rally higher and was now making higher lows on a 15-minute basis, and also had just made a higher high on a 15-minute basis. So even though my belief was that shorting call spreads was a good play on Tesla, that belief hadn't really shown up. It wasn't supported by evidence. We have opinions, but the key is, do we start to see evidence that supports our opinions? And in this case, the answer was no. There was nothing there. So just a poor entry again in that regard. And also, I started out trying to short the 225 by 227.50 call spread, but I wasn't getting filled where I wanted, so I ended up changing to the 22.50 by 225. And what pisses me off about that is, one of my beliefs is that you should try and fill your trade where you want to fill your trade, and if you can't fill it where you want to fill it, then either wait a while or just accept that, hey, this isn't the trade for me. I did neither. I only waited 10 minutes between the time I exited the first trade and the time I got in the second trade, so I can't justify that in that 10-minute time frame I was able to make a clearly rational decision that, okay, let's make this adjustment instead. So it just looks like, again, kind of forcing the issue on the short. Wasn't any evidence that said this was a good trade, so kind of took a flyer, which, no wonder it didn't work out in that instance. The only thing that I like about this, I always try to find a silver lining if you can with the trade, is I like that I went to short premium instead of buying puts for getting some short exposure. It was still wrong, but the result wasn't as harmful as buying puts would have been. But all in all, just need to remember, hey, you need a reason to get in the trade. Need justification for the trade. Oh, and then I've also mentioned that also changed the strikes I was trying to short. I wanted the 225 by 227.50. I settled for the 222.50 by 225. Had I been patient, I could have gotten what I wanted and maybe been in a different spot. But all in all, just not a good trade when you look at it in terms of what was the stock doing. Was it giving a great short signal? The answer is no. And by the way, I closed this trade right at the open. Now the one good part about this trade, again, I hate to keep coming back to the fact that the good aspect of it was taking the loss when I did, but the truth of the matter is, had I not taken this loss right away on Tuesday morning, I would have been in a very nervous position, because, so this is Tuesday, Tesla goes up right away, and I just stop out instantly. I saw the way the stock was acting pre-market, and I just did not think I was in a good spot. So I closed the position at a $50 loss instantly. And what's funny about this trade is, had I held it throughout Tuesday and Wednesday, it would have been just at a 100% loss or whatever. It went to be nearly 100% of the spread, so I would have been out much more than $50 unrealized. But by the end of the week, Tesla ends up closing below 220, so this call spread actually expired worthless. So the position would have made 100% if I held strong, but I would have had to hold through a 100% loss to come back to that 100% gain. So I don't know. Maybe I should have held. Maybe I shouldn't have. My point is, I didn't pick a good time to enter. Had I waited, I could have gotten a much better entry point and maybe made a much better trade. So when I look at it, I like that I closed it out right away because I can't envision myself not getting nervous if it would have gone so far against me the way it did. So good job closing it out when it wasn't working, but still need to pick the entry much better. Next trade was on FCX on Tuesday morning. I shorted FCX 175 shares on at 9:34, and then I shorted another 175 at 9:40, added to the position at 11 and 41 cents and 11 and 43 cents. This is on Tuesday morning. So FCX was gapping down pretty good going into Tuesday, so I liked the gap down pressure. I came into the week somewhat bearish on FCX to begin with based on some monthly charts I've been examining. This is a 1-minute chart. I want to look at a 3-minute chart because that's where I get my stuff from. Sorry. God damn it. All right, I promise the rest of this trade review is not going to take as long as this is taking me right now. Okay, here we go. So got into FCX because the stock had been gapping down, so I was kind of bearish going into the day. And my key level was $11.50. $11.50 was kind of my over-under setup. So I observed this move higher off of the gap, but then you started stalling underneath 11.50. So I like my entry point because it's pretty close to $11.50. My first short was at 11.41, and that was at 9.34. So I shorted this bounce right here, and then my second short was at 9.40. Yeah, 9.40, which was this area right here. So what I like is I take the first entry with a stop loss just above 11.50. I like the entry because it's awful close to 11.50 and my target's down near 11.20. So good risk to reward, risking 10 cents to make 20 cents. That makes sense to me in this case. And then it moves down a little bit, goes down to 11.35, and I remember watching level 2 and really liking what I was seeing. And so after that happened, I decided to size in for some more and be more aggressive. And again, the main reason I'm more aggressive here is because I'm so close to what I believe my key level is, which is 11.50. And one of the things I'm trying to get better at is if my stop loss is nearby, I want to make a more aggressive trade. So I size in right here, and then I catch this whole move down towards 11.20s. It bounces back a little bit, and right here starts to bounce back, but I stay strong, I stay patient. You get rejected at 11.35. I was watching level 2 very closely, felt like the asks were doing a good job, and then I catch this move. 11.20 was my target for half of my position, so I cover half of my position at 10.06, which is right here into that leg down. So I get filled at 11.20, which is great. And I'm thinking it could go towards $11, so I kept some exposure. It ends up bouncing back, and then I cover the rest of my position at 11:33 at 10:21. So I was a little disappointed that I didn't get to cover lower. Obviously gave back some profits in that. But, beggars can't be choosers. I was holding because I thought it could go down towards 11 based on what I was seeing. Once it started to do what I didn't like, which was basically regaining 11:30, then I decided to cover the remaining portion of the position. And I'm fine with that. Obviously in hindsight, you look back and you say, oh man, I wish I just would have covered everything. But we have the benefit of hindsight now. I didn't have the benefit of it in real time. So overall, good trade. I like the entry point. Not so much because there was a great short signal, but because risk reward made a lot of sense. Very close to my target, to my stop loss, and that's the main key there. So, and then with that said, I like the size in after observing a move down. It felt like I was in a winning trade, so I increased my exposure to it. Good cover for half the position at target 1, and just got target 2 wrong. It didn't end up going as low as I thought it could. Just got the second one wrong, so covered remaining. Fine trade. Next trade was on Facebook at 10:20. I went long at 117.90. This is on June 7th. So this is just one of my favorite setups to go long in on the stock, and that is when you just get what I call a washout. So like this move on Facebook, just nice trend move down from 119 down to 117.80 from 10 o'clock or 9:55 till 10:20 or so. And for me, what I like about these moves is it's clearly downtrending during this time, but once it bottoms out, it usually makes a counter trend bounce back up, and I can get 20 or 30 cents out of it. So to some people, maybe that doesn't make a lot of sense, but again, for me, this is something I've practiced for a while, and this is one of my favorite setups. So I like that I went after one of my favorite setups and was trying to bounce the stock. I got in at 10:20 and was trading versus the bottom, and then I sold 10:20 in terms of time, and then I sold Facebook at 117.79 at 10:28, which is right here. I understand why I sold, because for me, when I do try this counter trend move, the bounce needs to happen without making a new low. So as soon as it made a new low, then that is not what I'm expecting it to do. So I just got out. I gave it 8 minutes to work, and it doesn't work. So I like my execution there. Now, if you notice, it does end up bouncing and giving the move I was looking for, but not until after it made a new low a day. So this move right here is really kind of irrelevant for the purpose of the trade I was making in terms of risk management. So just one of those ones where the trade doesn't work how I wanted it to work, but I like that I attacked a favorite setup of mine, and I like the way I managed it once it wasn't doing what I wanted. Now the next trade was that exact same trade basically on Facebook again, but this time it was 30 minutes later at 10:49. And what I really like about this is, so what I had seen is after I exit, the stock ends up bouncing, and I'm like, oh, okay, that's the bounce that I thought was going to happen. So when that bounce happens, now I feel like Facebook has bottomed out for the day. And if it hasn't, then, it hasn't. But what I know is that I can now use the current low of day as my stop loss. So I revisit that exact same trade right here as the low of day gets tested. And I really like this because, again, I'm kind of attacking something that I'm familiar with, even though I'm not sure of the probability. In terms of risk and reward, I'm risking like 10 cents right here. So it makes sense to me to at least give it a chance. So I get in here at 117.87 and I'm targeting a move back up to the highs that it just came away from. And as you can see, the stock does just that. Does end up making a recovery back into that range. And I believe that I sold into that push. Yeah, I sold at 118.21 at 11.20. So I was in that trade for 30 minutes. So again, I like it. I like the attack. I like the attack and I like the risk to reward analysis. Nice trade versus the current low of day. And good patience in waiting for the target to hit because it did end up hitting. So good solid trade for what I was trying to do. Next trade was back on FCX. I shorted 100 shares at 11.29, and I'm just going to tell you now, this was an awful trade from start to finish because there was no reason for me to be in this trade in the first place. All right, so FCX, if you look at, look at this 3-minute chart. It looks like somebody's playing Pong back and forth or something. Just a brutal 4-cent range. 11.20 on the low. I guess not a 4-cent range. Sorry, 8-cent range. 11.20 on the low and 11.28 on the high. And really, for a long time, it was a 4-cent range. All right, so bottom line, what the hell are you doing, Kevin? This is how I know I was bored, I was distracted, I was something other than trying to make good trading decisions because there is absolutely no trade here. So brutal entry. And worst of all, what pisses me off the most is if you look, my exit is the next day. Why is it the next day? Because somehow I managed to justify taking an ignorant short trade overnight. And no surprise, when you do something ignorant, good things usually don't happen. The next day, FCX gapped up huge, and I covered it in the pre-market at a loss as it was gapping up. So awful, 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 awful trade. What are you doing? I'd rather you be taking a nap when a stock is moving as pitiful as FCX was than you be forcing trades like this and paid the price by getting stopped out into an overnight gap. Don't do stupid shit. And I'm serious. I'm not even trying to be funny. Don't do stupid shit. All right? That's stupid shit right there. Don't do stupid shit. I'll trade better. So then next trade was on Google, and on Wednesday, June 8th at 9:39, I went long Google calls and got a nice trade. Made 30% in just about 65 seconds or 75 seconds. So let's see what was going on with Google. So first of all, stock had a very strong gap higher in the pre-market. That's the first thing I remember noticing on Google, and 740 was kind of a trigger point for me. So I enter calls at 9:39, and what I like about that is off the gap, I gave it a few minutes to kind of trade around, and I was watching this battle between 738 and 740, and every time it was coming down to 738s, it was getting bought back towards 740. So I liked that. I liked what I was seeing on level 2. This was more of a level 2 trade than a chart trade necessarily. It did work out though. Obviously you can see the stock made a nice spike up there, and by the time it was Wednesday, premiums really start to move if the stocks are moving. So I was able to make, that's how you make that 30% in just under 2 minutes. It was an aggressive trade, But, you know, gotta do what you gotta do sometimes. So I like the aggressiveness in this case because I observed a setup. I saw the gap pre-market. I saw the sideways action. And also, this doesn't show up on the order, but I got filled on the bid. And that's always very important to me when trading Google, because Google has very wide option spreads. So if you fill Google on the ask, you're basically risking 30 cents right off the bat because of that spread. So by being able to get filled on the bid, I have that spread working for me as opposed to against me. And I felt like that was a key characteristic that made this a successful trade. So good observation, I would say, of the gap and hold higher. And I like the aggressiveness. It shows confidence. I like that I kept it to one contract. I didn't try to be a hero or anything. I like that I filled on the bid, which I think is very important for successful Google trading. And I like that I exited into the push right away. Wasn't greedy. Took my 30% as I was targeting 742s, and that's what I got. So good solid trade. Next trade was back on Google. I revisited those calls because the stock dipped. So I went long at 10:03. First of all, I went long stock at 10 o'clock. So trades 11, 12, and 13 are all kind of just one big trade. I went long stock and I went long calls as the stock dipped at at about 10 o'clock. So some things I like, some things I don't like. Number one, I like that I'm giving the stock a chance here kind of versus this 740 to 741 range, because at the open that range had been resistance. Let me put a clear straight line there. So this had been resistance at the open, right? And then once we spiked above it, or once we got above it, we got a nice little $3 spike. So the stock pulls back and I'm thinking, okay, here's a back test of previous resistance. I'm going to go long and see if it acts as support, and if it doesn't, I'm going to cut loose and take a loss. So I really like what I'm trying to do here in terms of my mentality in approaching this setup, buying the back test of the morning breakout. That's what I like. What I don't like is I do it 3 times. Okay, I buy stock right here, I buy one option here, and then I buy another option here. So it's like, come on, man. Why are you doing that? I'm over leveraging myself. And it just doesn't work. The stock continues to drop. Now, I take a good, smart stop loss. I get out as soon as Google starts to lose 740 right here because something ain't right. And I'm very happy with the stop loss because, as you can see, the stock just kind of tanked down to 735. So had I not stopped out, I would have been shitting myself for a minute. So really like the stop loss, but the problem again is that when we go look at my orders, okay, any one of these by themselves is a good loss. $25, good loss, good job. $15, only a 7% loss, good job, good job. $26 loss, good job. Those are all good losses by themselves. But when you add them all up, now I'm talking about almost $70 worth of losses, and I've just given back all of my gains from the one winning trade that I had made 20 minutes previously. And that's frustrating because it's just not smart risk management, at least not the way I've tried to train myself. So I don't like that. All right, and again, just to be clear, my problem isn't with the trade at all. I think it's a good trade, quite frankly. I think this was a good trade setup, buying a back test of the opening breakout resistance. So I like the attack mentality. Again, it shows confidence, but that's really where it ends. Well, and also I like the stop out. I like the stop out a lot as well. Once it wasn't holding how I wanted it, I exit because something was wrong, in my opinion. But that's the only positives here. The major negative, which turns this from a good losing trade into a frustrating losing trade, is the fact that I over-leveraged myself. I put myself in a position to give back gains, which just isn't smart. You know, need to be protecting gains. Again, like I said, any one of those losses by themselves is not a bad loss at all. But when you add them all up, it turns into a bad loss. And so number 8 was the option trade. Number 9 was the share trade. So again, I do think it's a good setup. But after I take the shares, I don't think I should be looking at options unless I am up more at that point of the day. You know, had my first trade of the day, had this one where I made 30%, had that been on 2 or 3 contracts, then I wouldn't be as annoyed with taking bigger size here on this second trade. But I put myself in a position to give back all the gains from that one good trade, and that's where my problem is when I analyze that. So next trade then was at 10:14, and it was on Google. I was trying to bounce Google. So the stock just tanked. I mean, if we look at this here, so Google tanks, just goes straight down from 743 down to 735. I go long again at 10:15, kind of versus 736 to 735. Again, I kind of like the entry, to be honest with you, because now I'm closer to that round level again, and it's very, very similar to the Facebook trade that I went over a few moments ago, where I said how anytime a stock goes straight down in downtrends, it usually tries to make a counter trend back up before then possibly continuing the downtrend. So I like my entry here on Google. I end up exiting this position at break even 7 minutes later, as it just wasn't bouncing like I wanted it to. I sell just before the bounce ends up happening. Not going to beat myself up too much, but you know, if I was at break even, that tells me that I could have still given it a little chance to try and see if it did end up making my move. So decent setup here for a bounce play, which fits the criteria of my straight down setup. I sold break even, which is just kind of meh. I'm not really sure how to describe how I feel about this. I think meh is the right word for it. Could have done better, could have done worse. All in all, didn't hurt myself, but didn't help myself either. Next trade then was on Google again. I was having tunnel vision with Google, I guess. So I short Google at 10:44 at 739, and I covered at 10:54 at 737.97. I shorted larger size, and the reason I shorted larger size is because I was trading versus 740. Now, what I like about this trade, let me just get the time right. It was 10:44. Okay. So what I like about this trade on Google is, now remember I said you get that move down, and then I look for a counter trend bounce. There's the counter trend bounce, and then I'm ultimately looking for a continued move down based on, you know, what it had done starting at about 10 o'clock. So Google starts to go sideways here, and 740 is this line right here. just about. So it's in the 739s. Here's 740. I get short right around here after it has clearly gone sideways for 15 minutes. So I like my setup in terms of risk and reward, because what I'm thinking is, hey, it's either going to go back above 740 and continue uptrending and I can stop out on a short, or it's going to go back down towards 736-ish. So I'm basically risking 1 point to try and make 2 to 3 points here. So I like the risk and reward. That's why I put in larger size. Like I mentioned earlier, if I'm able to identify my stop loss and my stop loss is close by, then that allows me to be more aggressive. That's what I do here. I cover the position at 737.97, 10 minutes later at 10:54. What I don't like is my target was 737 and I adjusted up. I lost patience. And as you see, so my cover is here at 10:55-ish, this candle right here. As you can see, within 10 minutes it did go below 737. I had a bid to cover at 737, which I canceled and raised up to 737.97 to get filled. So I lost patience on the short, which I don't like seeing because it tells me it's a lack of confidence in that. But good setup in terms of risk and reward. Again, I like the aggressiveness here with my size being that I'm close by my identified stop loss. So I trade bigger size. I don't like the loss of patience. Held for 10 minutes. Had I held for another 7, I could have gotten my official target. So just need to maintain that confidence. Was in a good spot. Okay trade, but not good enough. So next trade then was on Tesla. I bought calls at 11:25, and again, it's a situation where I'm basically making one trade here. I did this two times on Wednesday, strangely. I buy shares in Tesla at 11:22. I go long shares, and then I also buy calls at 11:25. Had I been having a much better day, I'd understand why I was kind of over leveraging and stuff. But given that I was kind of having a flattish day, I don't understand. Well, I do understand. The reason I'm over leveraging it is because I'm trying to force the issue and make some money, and that's just not right. That's just not the right approach. When you try to make money, at least when I try to make money, trading doesn't usually work out too well for me. When I try to make good trades, then trading usually works much better. So let's look at Tesla and see what was going on around 11:20 on Wednesday. This is a risky setup, man. I'm telling you that right now. Even though one of the trades worked, I don't really like what I see when I look at this chart. So I go long Tesla at 11:20, which is right here. And the reason I say I don't like this setup is because it's in a clear downtrend off the high. Lower highs, lower highs, lower lows, lower lows. And it's not like it went straight down, right? I mean, this is much more of a methodical downtrend where it's up, 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 right? As opposed to the Google, Facebook setups that I've talked about previously where it's kind of straight down and I play for that counter bounce move back up. So I do not like this setup. I do not like what I'm attacking here at all. Just way too risky given the setup. Now, I get lucky, quite frankly, and the stock bounces just a little bit, and I got the 7% I was looking for on the option in at 276, out at 297. Was just trying a quick scalp trade with 2 contracts. You can see I was in and out within under 60 seconds, about 45 seconds I was in and out of that thing. So uh, again, I don't like the setup when I look at it. It seems way too risky. However, I think I executed well given the risk. Just got in and got out right away. Didn't mess around. But be careful putting yourself in these types of trades. Risk reward doesn't make sense, or didn't make sense to me when I look at it. And you know, there's no, so, let me restart. Risk reward doesn't make sense, number one. There's no clearly identified stop loss, number two. And there's no edge. It didn't just go straight down. I'm not playing for a counter trend. I'm just buying on a whim, so to say. And then trade number 13 was with shares, which I end up taking a loss on at 11.51. And that one, you know, I just stayed in the trade way too long. It's the same exact thing. There's no edge here. And this reeks of trying to make money instead of trying to make a good trade. And you can't have that, man. I'm going to get burned if I keep trying to do that. No edge. All right, next trade was the next day. It was on FCX. And again, 18 and 19, this is just one trade here with two different entry points. So number one, FCX was gapping down huge in the pre-market, which had me feeling bearish coming into the day, or coming into the open. Number two, some of the reference points I look for on a big gap down is the pre-market low. Because if a stock gaps down, and if a stock is gapping down huge in the pre-market and goes below the pre-market low right away, then that just speaks to how much pressure there really is. That even after a 5% gap down, she still can't bounce at all. And as you can see on FCX, our first candle of the day just goes straight down below that pre-market low. So that had me feeling extremely bearish on FCX. Extremely bearish on FCX. So I get short right away at 931 because I'm watching level 2 and it just looks super heavy, and I'm trading versus the 1130 level. The reason I'm trading versus 1130 is because that was about the pre-market high during the 8 to 9 o'clock hour, which, you know, again, some of this, maybe you think it's meaningful, maybe you don't think it's meaningful. For me, having watched FCX a lot, having tracked big gaps down in FCX, I make note of the pre-market ranges. I think they're very important when this stock gaps down. So stop loss was going to be 1130, and my target was underneath 10 bucks at 1085, which was about a 1 month low. That's where I thought the stock could go. So I get short pretty much right away, and then I get short again, or I short more at 1109 at 936 after having seen this bounce attempt back up get sold back down. So I like the aggressiveness here, and I like the patience as well. I get short at 931, 936. I cover the position at 1093 as at 1006 as the stock breaks to new lows underneath 11 bucks. It did drop a little bit lower, but then just kind of went sideways all day. So I caught the bulk of the move. So this is a good aggressive trade here, and I like it. I traded FCX pretty well this week, aside from that one, you know, poor decision on it. So good recognition, I feel like, of the extreme bearishness pre-market. That recognition allowed me to make an aggressive trade comfortably. And I added into it, which tells me I had good confidence. And then good cover as well. You know, caught 22 cents, which is a good job. Caught the bulk of the move. Good solid trade. I like that one. Just so you know, FCX is going to be a continued short setup, I think, for the time being. Alright, so then on Friday, last day of the week here, I was trading Tesla. And started out the day at 9:35. I bought a Tesla put. So let's look at Friday from Mr. Tesla. So number one, Tesla was gapping down coming into the day. Number two, it had sold off into the close on the afternoon of the previous day. So it sold off Thursday afternoon in the close, and then Friday morning was gapping down. So starts to drop lower and starts pressuring 225. 225 was my breakdown level. I felt like if Tesla got below 225, she could go down to 220 on the day. So I get short right here, trying to kind of front run a 225 breakdown. This was an aggressive trade, so you have to be careful on aggressive trades, and it did not work as Tesla started to bounce. But I like my management. I was very, very aggressive in getting in, and as a result, I was very, very aggressive in getting out. So I just took a 7% loss, 7.5% loss, which on expiration Friday, if any of you trade weekly options on expiration Friday, you know how hard it is to keep your losses at 7.5% when you get things wrong, because the options move extremely fast. So look, try to be aggressive, didn't work, and got out just as aggressively. So good management. Good management on this trade. Not the best entry, but when you don't get good entries, have to have high standards for what I want to see. I didn't see that, so I got out, no questions asked, and that's what I like the most about this trade. This to me is a good losing trade on an aggressive attempt. The quotes should be around good. Because again, guys, you know, good trades are not measured by if we lose money or if we make money. Good trades are judged on how well do you execute. And in this case, even though I lost money, I felt like I executed pretty well. So then after that loss, I actually go long Tesla, and this was more of a level 2 trade that doesn't necessarily show up on the chart. So I buy a call at 944. I buy a call at 944, and again, this was more level 2. The chart shows a little bit something though, because you try to get down to 225, but then you pop back up. And this candle right here was where I started to get long. Oh, no, actually that's wrong. I got long just before that candle. I got long when you came down to 225, and then I saw the asks immediately come back up to 226. Again, this was pretty much all level 2. If you want to learn more about level 2, get in touch with me. I'm happy to go over it with you, because there's a lot of things that show up on level 2 before they show up on the chart. So I get long Tesla versus 225. Because I'm kind of thinking, you know what, this thing's avoiding a breakdown below 225. I'm seeing some things on level 2 that are making me bullish. So I go long, and then I get out at 154. I make 28%. I get out at 957. That might look good, but it's not as good as it should have been. I had a sell order placed at 175. I canceled that sell order, so this I get long here. The stock bounces up here. I'm thinking, okay, this is looking good. I'm going to get my 175, which would have been like a 40% gain. And I'm feeling pretty good about it. But then it makes this move right here. And I'm like, oops, don't like that. So when it makes that move right there, I canceled the sell order at 175 and was prepared to sell into the bid if I needed to. Then it bounces back right here. After it bounces back, I felt better about it, obviously, but I did not replace my sell order back at 175. I was just kind of sitting with without an open order, which is a big no-no. I think for me, I always try to have orders in, because what happens if it only trades up there for a second and I can't get filled, and now the spread's 30 cents and now I need to sell into the bid and I'm giving back 15% that I should have had if I would have just had my sell order in place. And as luck would have it, that's exactly what happens. Tesla spikes up here, goes towards 228. My call options hit like $1.85, but my sell order is not in there. So then what I need to do is I end up selling it after it comes back down, and I sell it at 154. Now it's a good thing I sold it at 154 because Tesla went on a tank and those options expired worthless. But the point remains, I was not prepared enough. I did not put myself in position. Well, actually, I didn't put myself back in position to get the profits that I should have had. So first of all, good adjustment. The short trade didn't work. So I tried the long trade when I saw some bullish action on level 2. Ends up working well. However, rookie mistake of not having an open sell order in, which didn't allow me to get the optimal price that I should have had. And again, my sell order was in at 175. I canceled it when it looked kind of spotty there for a second, and then I didn't put it back when it started to firm back up. So above average trade, but could have and should have been better if I just clean up some simple mistakes. Replace that order. Trade number 17 was on Facebook. So what time was this at? This was at 10:47. So I don't really like this trade. There's just no edge. There's no movement in Facebook. I remember making the trade, and in my head I was thinking, hey, this is a channel trade. The stock's been in a channel all day. I'm not a channel trader. It's not one of my strengths at all. I do believe in trying to improve your weaknesses, but I also believe in picking those spots in which you try to improve your weaknesses very carefully, and this doesn't look like it was an optimal spot to try and improve that weakness. So in at 117.68, and then I exit at 117.79. 7 minutes later, I like the exit because I think I remember my thought process was kind of like, Kev, this isn't your trade. Like, this isn't your style. Just get out. So don't like the entry. Don't like the setup. Or just general style of the trade. Therefore, I like my decision to exit when I did. Now, last trade of the week that shows up on the list was actually a trade I entered early in the week, but it wasn't closed until late in the week. I shorted the Facebook 117 by 116 put spread for 27 cents, so I got my 25% of the spread that I try and get. And my thought process was Facebook was going to close the week above 117, and I was thinking that because I came into the week bullish on Facebook, because I've liked the way it's been holding 117 to 118. We know that that did not happen. Facebook broke down a little bit on Friday below 117. But again, my reasoning here was, if we're looking at a daily chart, hey, Facebook hadn't closed below 117 one time in the last 3 weeks. So I entered this position on June 7th into this weakness day, which I like. I took the position into a day of weakness when Facebook has been recovering from weekdays, and it just didn't happen. Look, Thursday, it looked like this was going to be a solid winning trade at 100% profit. Obviously, though, Friday, that changed. So just kind of happens. I could have closed it at 7 cents, but honestly, I was trying to get the full credit. And some people, when they do spreads and stuff, they say always close your spread, always close your spread. You never know what can happen. Some people say no, if you think it's gonna expire worthless, just keep it, keep the commission. That's what I thought was gonna happen. I'm still kind of new to trading spreads. I've only been doing them for like 6 to 9 months. I haven't decided which camp I'm in, if I'm in the always close it or the try and let it expire worthless. I will say on this particular trade, if I could do it all over again, I would trade it the exact same way, because I did not think Facebook was going to close below 117 this week. I felt like I was in a pretty good spot, and obviously I just got it wrong. Now what I like, though, is that I did close it at 2 o'clock once Facebook started to approach 117. If we look at the intraday chart on Facebook from Friday. So after this big breakdown happened to new lows on an intraday here, I was like, well, that sucks. But I took the first little bounce back as an opportunity to just close the position, because I said, you know what, just be done with it, man. Like, it looks like it's in danger of losing 117. And that was a very good decision, because if I hadn't done that, the spread would have actually turned into a loser, which is, there's nothing worse than a winner turning into a loser. So again, still going to have to figure out which side I'm in as far as closing it or letting it expire worthless. Spread trade that I was confident would expire worthless. Obviously, it did not. So, got it wrong, but honestly felt like I traded it right. I'm surprised Facebook lost 117 on Friday, but I recognized it and closed it. Didn't get stubborn, and that was a good decision. Not being stubborn is usually a good decision, huh? Alright, so that's the wrap up for this week. Some takeaways that I have when I look back on this is, number one, FCX, I felt like I had some good reads on this thing. Only one bad decision on FCX, and it was an easy fix. Need to be more disciplined. So that was a positive. Some things that hurt me, though, was over leveraging. Tesla and Google, those examples come to mind. But the winning trades that I did have, I really caught some good percentages. When I look up at my winners on Google, look, I've got a 29% winner here. On Tesla, I've got a 28% winner there. Those are two really solid percentages. On FCX, I've got 2%. I've got 1.75%, which when I trade stock, 2%, that's a good percentage for me to be able to make on a day trade. So some really good percentages on the day trades, on the winning day trades, and also some very good percentages on the losing day trades as well. Google, only an 11% loss on the option, only a 7% loss on a Google option. And then I had a Tesla trade where there's only a 7% loss. So some very good management on my losing option trades. But that is not an excuse for making losing trades in the first place. Need to get my win rate up to historical standards. And so just so you guys know, for me, my historical win rate since 2014 is 56%. I win 56% of my trades since 2014. Since May 1st, I'm only winning 45% of my trades. So that's a problem because I'm managing losses properly, but I'm making too many of them, so those small losers are adding up. Where if I can get that win rate back up to my historical norm, now I'll start seeing the margins. I'll start benefiting from the margins I'm getting when it comes to how I'm managing those losing trades. So need to get that win rate up, need to be more disciplined, and focused. Overall grade, I'd say it was kind of a C. I don't think it's a C minus or a C plus. I'll just go with a C. All right, guys. Good luck this week. I'll see you next weekend.